Good afternoon and welcome to our annual report 2021 of Basler, or Basler's annual report 2021. For those of you who don't know me, my name is Hardy. I'm CFO and COO of Basler, and I'm happy to present you our very good results for the year 2021 and give you also some more insights. And we will do this in a classic way. We start with an executive summary. We will then dig into the financials a bit deeper, especially the P&L and cash flow parameters and some balance sheet parameters. And the third paragraph here, we will have a quick glance at the share and also our dividend that we will suggest for the supervisory, for the main shareholders meeting or in the main shareholders meeting. And last but not least, we will come to the outlook for this year. Yeah, let's start with the executive summary. And in a nutshell, I'm really happy to present you great numbers in a very, very challenging year for us. We had three main circumstances in the environment around us that doesn't make it easy to, or didn't make it easy to create such results. First of all, I mean, COVID was still around in 2021, also had impact on the organization at Basler, but even more so the impact on the supply chain. And we had the chip shortage that hit us pretty hard, as many other electronics companies in the world as well. And last but not least, more or less on the finishing line of the year in November, second half of November, cyber attack hit us on top of it. The fact that we were able to create the results we did, we believe as a management board, is demonstrating the resilience and the strength of our team. And also we would like to thank again all our team members in this call for such a great job, and also our partners to support us very well to achieve those numbers. And talking a bit about the numbers, first about the market environment to make it more quantitative. The market environment was good last year. The market bounced back after a weak 2020. We had a strong 2021. The industry's billings grew by 17%, the industry's bookings by 28%. We saw continuously a strong demand in semicon, electronics, and logistics. We also saw this in the year before, but we also saw over the course of the year that medical, general factory automation, and other verticals recovered over the course of the year and kicked in the second half or in Q2 already. From a regional perspective, the strongest momentum over the course of the whole year was in Asia, and then followed by Americas and EMEA. Also time-wise, it was Americas and EMEA followed, and Asia was already strong beginning of the year. The consolidation trend continues in the market, and we also took part of it. We acquired two of our distributors in Korea by end of the year to be effective beginning of this year. Our performance in this environment: bookings up 78%, billings up 26%. So pretty strong business also in comparison to the environment, especially very high bookings. And we will talk about this, the gap between bookings and billings growth, that is mainly can be explained by the supply chain constraints. Earnings were even up 37%, so we had over proportional growth on the earnings side and leveraged our organization. On the production output, 28%, so close in line with the billings. And this needs to be mentioned here because under this severe supply constraints, and also COVID circumstances. It's definitely we would have wished to produce and sell more, but we believe it is a strong performance that we have demonstrated. And due to the fact that we have quite a lot of gap between bookings and billings, we created a significant backlog, which gives us very strong tailwind for the year 2022. The team itself, you can't see it in the numbers, but we started or not in the numbers yet. We have started last year already a hiring program in Q1. We increased the number of talents, approximately a number of heads by end of the year, or number of full-time equivalent increase approximately 60, but we signed already approximately 150 new contracts, and these new people will start soon or have already started. So we are in the midst of a significant hiring program. This hiring program will be also continued over the course of 2022. And in addition to this, I mentioned it already, we also acquired 50 new colleagues in Korea. That gives us now a very strong presence. The two acquisitions we did of our two distribution partners give us a very strong presence in Korea, with highly talented people on the sales, on support, so tech support, on sales admin side, and a lot of local flavor in Korea. So from the products perspective, also here we innovated a lot. We also we invested a lot, approximately 13% of our sales. We invested in R&D, and we brought out new products on the mainstream side, so new sensors on the ACE2 platform. We brought out on the upper mainstream or high-end products new boost variants, and also combinations with frame grabbers, so pre-processing cards. We also innovated in the field of embedded, that you can see on the left-hand side, so processing and design boards. And we also introduced Basler Light products, and this is demonstrating now also our move towards the full line provider. And in the center is our biggest investments that we do, the biggest investments with regard to software, our software development kit Pylon, which is the gateway for our customers, typically the engineer at the client's side, that chooses different hardware components but needs to connect those components and design and spec it into their machine. And for this, Pylon is needed, and Pylon is becoming also a key differentiator in our offering, and the gateway, as I mentioned, to the overall, and this is also shown here, to the overall Basler hardware ecosystem. On top of those standard products, we are also step by step realizing more customized solutions. It's still approximately 20% of our business. Also last year it was that area, but we see more and more demand for customized business, but we leverage it on the basis of our standard components, and typically do this for larger accounts where the business case is attractive. All in all, this picture is not new, just a reminder, we are on our transition from a single component, so a camera company, in factory automation on the lower left-hand side, and we are step by step moving into a full range provider position for computer vision. So by diversifying our business and expanding our product line, as well as going and moving into different market segments, from factory to medical to ITS, logistics, and also to retail automation applications. Having this said, I'm already closing the executive summary, coming to more details on the financial side. We start with the top line. bookings and billings. Interesting picture here. You see the last 8 quarters, so 2020 and 2021. And you can see maybe first of all that we have already 5 quarters in a row a significant positive book-to-bill ratio, and especially in Q2, Q3, Q4, the gap between bookings and billings further increased because the order entries were very high, on a very high level for those quarters, but the supply, as you can see, or the revenue we created, even were going down a bit in the second half of the year. And the root cause of this is only chip shortage. Even though we started to order significant more materials already back in Q1 last year, we are lacking a few of critical components that are slowing down our production, or that slowed down our production last year in the second half of the year. All in all, as mentioned earlier, we almost grew 30% in terms of unit output. So it's not that we are going down, but we are obviously not satisfied, and our customers are not satisfied with the output in general because of those high booking level of 85 million per quarter. From a regional distribution, also no big difference in comparison to the former years. Asia, our strongest footprint, even increased a little more. 57% in total of our revenue was created in Asia, more than half of it in China, of this part here, not the overall of the Asian part. 28% in EMEA and 15% in Americas. As mentioned in calls earlier, we have some distortions between Americas and Europe because we have some US customers who have purchasing hubs in Europe that are counted here in Europe or in EMEA. This needs to be considered. Yeah, going further down the P&L to the gross profit, and in absolute terms, and the gross profit margin. You can also see this here for the different for the quarters in 2020 and 2021. So all in all, it can be seen that all absolute gross profits were each quarter were higher than previous year, especially Q1, Q2, due to the high revenues, were pretty high absolute gross profits, but also relative. The gross profit margin here above 54% were on a very high level in the first half year due to better utilization, so higher outputs. And then it slowed down a bit in the second half of the year in the area of 50%, 51%. And the main reason here are twofold. Or the one is lower utilization rate, but the main impact on the gross margin that we saw where spot-wise we did in the second half of the year. We did them already in the second quarter. However, they materialized in the second half of the year and slowed down or had a negative impact on our gross profit. What we did is we did not forward these spot buys, additional spot buys expenses to our customers because we are in the design-in business. We decided to keep our customers short-term free of it in order to remain our very good customer relationship, because these are temporary effects, only no structural long-term effects. The picture you could see from a structure, you can also see here on the earnings, earnings before tax in absolute terms and in margin. First half of the year, Q1, Q2, very strong earnings in absolute and relative terms, and the second half lower in absolute and relative terms. mainly due to the two effects that I mentioned, lower revenue combined with lower gross margin due to spot buys. Yeah, summarizing the profit and loss sheet, going through the different parameters again in a year-to-year comparison. Order entry, I mentioned already, almost 80% up. Sales up 26%. Gross profit stable, so we were able to, over the course of the year, to equalize those effects that I mentioned earlier, more or less, to have a stable gross profit over the course of the whole year. The earnings or the EBITDA grew to 44.5 million euro, 29% up, and further earnings, be it EBIT, EBT, or even net income, here in the range of up 38%. So our earnings before tax was at 28 million and net income at 20.8 million. So what you can see here is higher earnings before tax margin, also from 12 to 13%. And all in all, even though we had the strong headwind from the material side, and we hired new people, we were able to even increase our profit margins. Yeah, let's have a look to the free cash flow. Also here, worth to mention some effects. Again, here on a quarterly basis in 2020 and 2021, we started the year relatively in a classic way with a moderate free cash flow, because typically by beginning of the year we increase accounts receivables because the business is picking up. This also happened in 2021. But then we had a very strong Q2 with almost 10 million free cash flow in the second quarter. And then the cash flow was decent in Q3 with 5.4, but then slowed down or even had a negative free cash flow in Q4. The main effects are twofold here also. That needs to be explained. In the second half of the year, due to the effect that we increased our orders for material already beginning of last year, a lot of material kicked in. We will also see this later on the balance sheet data. But on the other hand, a few components were missing, so we were not able to produce and supply enough. So our inventory increased. This is effect one. Effect two, especially here in Q4, that had impact on the operational cash flow, was the fact that we had the cyber attack in November, and we tried to produce like hell in December in order to compensate for the gap in production, because the cyber attack had the effect that we were not able to produce for 2 weeks in a row. So fortunately, we were able to compensate quite a lot of, not 100%, but quite a lot of those. We shipped it out by end of December, and we created with the shipments not extraordinary, but much higher accounts receivables than normal by the end of the year. So this is definitely also a temporary effect. Yeah, having a look on the liquidity over the course of the whole year. So we started the year with approximately 48 million on the cash account. The operational cash flow was 25.3, so lower than the year before, mainly because of the inventory and the accounts receivable effect that I mentioned. So we increased working capital. The cash flow from investments were lower because we had no or almost no extraordinary investments in M&A over the course of the last year. We had a free cash flow then of 10 million, so a little bit lower than the year before due to the lower operational cash flow. We had a financing cash flow from -3 million, so the main effects are here the dividend and also some purchasing of treasury shares beginning of last year, and then there are also some additional bank loans we got, and some bank loans we paid back. So the net sum was -3.1. So by end of the season 2021, we had a cash account of 54.8 million. Yeah, a quick glance to the balance sheet, simplified one here. Maybe first of all, if we look at the balance sheet, the overall size of the balance sheet increased by 20%. Our revenue increased by 28%. So in correlation here, the balance sheet got leaner. And here you can see the two main effects I mentioned earlier. Inventories went up pretty significantly on the asset side with 86%. Receivables, accounts receivables, 71% up to 33.3 million. And these are the two main effects that you can see that impacted and extended our balance sheet. They are both related to the very special combination of supply chain constraints and cyber attack. On the liability side, worth to mention here are the increase of the short-term accrual liabilities and the short-term other liabilities. The short-term accrual liabilities increased by 116%. This is mainly a bonus accrual for all employees and management due to the overachievement of the year and also the extraordinary performance to master chip crises and cyber attack. And on the short-term other liabilities, this is mainly an increase on accounts receivables due to the aggressive ordering of material, because what we can see is that this becomes, to be able to deliver becomes a significant competitive advantage. And we are committed to do whatever we can to increase our supply. Yeah, leaving the financials and coming to the share. Maybe first of all here, a share price, share development chart compared to the TecDAX. So you can see that over the course of the last year, we were able to outperform the TecDAX quite significantly. The share price from beginning of 2021 to end of 2021 increased approximately 120%. So at the moment, the share price went down. Also, the market went down since then. But we are pretty happy with the development of the share. We are also very happy that, and it came as a little surprise also, that in autumn last year we were included in the SDAX. So this made us proud. This also motivates us to step by step even further grow the company and our presence on the stock market. In line with our dividend policy, we will propose the main shareholders meeting a dividend of 62 cents, which would mean that we pay out 30% of our earnings after tax. That is absolutely in line with our guidance, our share price guidance or dividend policy, and also demonstrates the step-by-step increase of the annual dividend. For those of you who are looking at the chart and are not so long with us, 2017 was really an outstanding year And in 2019, we deviated from our dividend policy due to the unknowns of the COVID-19 that kicked in the beginning of 2019, and nobody knew what will come. Yeah, this is then the chapter 2021. Now coming to the outlook 2022. And for 2022, we expect from a market environment perspective that the demand and the order entries and the order horizons will stay strong and high in the first quarter of this year. And we believe that once the supply is getting also better, there will be adjustments in order behaviors of our customer in the second half of the year, and also that we believe that, which is also a seasonal effect, that in the second half of the year the demand will start to slow down. So this is our projection at the moment. Just to give you a recall, we had by end of 2021 approximately 140 million euro in backlog. So quite a strong backlog. So this makes us also confident that we're gonna see it in a good demand in the year 2022. Our revenues, this is what we expect, our revenue growth will be limited by supply shortages, not by demand. So the story of last year will continue. However, we also believe we can improve step by step further our production output and outperform our competitors and give a better service to our customers. Our gross margins continue to be impacted by expensive spot buys. We have done a price increase beginning of this year, but this is mainly due to structural price increases on our side. For spot buys, we do along the way in order to buy short materials on the spot markets. We typically do not hand it over to our customers, and this is why we will see also further impacts continuing, but these are again temporary effects. Our organization will be increased. I mentioned we have signed already last year 150 new contracts. We are planning to hire, let's say, in this year in the same range. We also, I mentioned, had the M&A transactions in Korea in December that become effective now in January. So this means for us HR costs and OPEX costs will grow, and they will grow over the course of the year because we get more people on board, and we also expect that COVID restrictions will become lower over the course of the year, that create typically higher travel and higher event expenses. Extraordinary cash impacts will be seen in the first half of the quarter of this year due to the acquisitions that I mentioned already. So under these market conditions, we are happy to announce another year a double-digit growth with a sound profitability. Our revenue projection for this year is a corridor between 235 and 265 million euro at an earnings margin or earnings before tax margin between 9 to 12%, depending on the revenue where we end up in this revenue corridor. And this step forward will, let's say, bring us one milestone further to our midterm plan that we already announced in January, but I would like to repeat it in the midterm. So until 2025, we want to grow the company to 400 million revenue. For all of you, we try to keep the company in the range of 12% earnings before tax margin. Also for everyone, again, this is not that we are not able to get more efficient. The processes and the company is getting more efficient, but we are willing to hire more people, and this creates OPEX and HR costs and not so much CapEx. And this is why we are continuing to grow the company. And this is also what we plan beyond the 2025. And this is why we do not optimize earnings margin, but we want to have a sound and decent profitability, and everything else we are willing to invest in order to grow the top line and to achieve our long-term goals. Yeah, having given this outlook for 2025 and also the outlook for this year, I'm at the end of my presentation and would like to start the Q&A session.